All right. Welcome back to Wook Capital Management's 51st edition of our weekly Wook and Review broadcast. I'm Managing Director Rod Alsman, joined by Joe Fonicello. We are going to be walking through our prepared content from our newsletter that we send out every Friday morning. You can access the link to that in the profile here at the @Wook Capital handle if you'd like to access the latest one. Joe, I think you're going to pin the latest little Twitter thread. Yep, so I see that pinned up at the top. Just for anyone who's not joined these before, we're obviously streaming live on Twitter, which doesn't have visuals, but I am sharing my screen in the GMEDD Discord on the Stages channel. So if you're watching this replay, though, of course, you'll get video and audio on YouTube. Before we get underway, we live in a litigious society, so I want everyone to know that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on the information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So with that mouthful out of the way, again, I'm in the Stages channel in the GMEDD server. If you want to submit questions or comments through text, you can do so there. Obviously, if you're here live, please feel free to join as a speaker, and we welcome your contribution to the discussion. Just as an FYI, if you're following the visuals, I'm using my standing desk today, so that's why you might see the light from my ceiling fan behind me. So apologies for that. I'm an old man and my hip was hurting, so I'm trying to do the old standing thing. So, okay. Joe, anything you want to add before I get into it?
No, I was going to ask you what's up with the camera angle, but I guess if you're at a standing desk, that's why.
Yep. All right, cool. So Joe put together this week's newsletter as he always does. Thank you for that, Joe. It looks like we have a few topics, some of which are continuations from what we've talked about both during Wednesday's open mic as well as last Friday. So try not to be repetitive, but there is obviously a lot of discussion that we can have on labor and on the UAW strike. There's been incremental actions taken today that we can update. Let me go sequentially here. Joe, you put a story in here about Nvidia. You want to speak to that one?
Yeah, just thought I would keep it updated because that is one of the stocks on our watch list. We try to provide any updates that come forth on these companies every newsletter, and Nvidia is one of them. Essentially, just putting in the 180 billion in market value that has been lost since about August 31st, as shares tumbled about 10%, and didn't really dive into. Let's see, Rod's pulling up the ticker right now. Actually, I'll let Rod take over from here. Actually, if he's going to pull up the charts.
Yeah, I mean, look, we've talked about Nvidia a lot. I mean, if there's not really material new information, I don't want to belabor it. We kind of talked about. I mean, look, people have fun with Nvidia, kind of touting how rich it looks when valued on a trailing basis. It's not new. It's still valued north of $1 trillion, but markets are forward looking. You know, you're not going to get your returns from what's happened in the past, but from what's happening in the future. And for the time being, you know, the analysts, right, still see very substantial revenue growth. So I've just pulled up this graphic here is a 3-year trend of sell side. Let me get my head out of the way. There we go. So 3-year estimate of sell side EBITDA. Look, massive uptick in EBITDA estimates. And if you don't like EBITDA, we can use bottom line earnings per share. Massive uptick in earnings per share estimates, especially in out years. And look, it's rich. There's a lot of growth expected, and really the question mark is that growth going to come to fruition? Because if so, you could make the argument it's not that richly valued. Looking at some of these multiples based on the sell side growth that's expected. I mean, you're talking about a 21 times full fiscal year 26 EBITDA multiple, which isn't low, but it's also not really high. It's trading at what the sell side sees as 37 times full year 24 EBITDA. So the forward price to earnings ratio is 28. It's about on par with Apple. Again, if the growth comes in from all of these GPUs that they're clearly the leader in, for now at least, then one could argue perhaps it's undervalued. I do, in my personal account, still have some what are now deep out of the money puts. I don't know that that growth is going to come in the way that is expected, but look, it can keep going, and there's no reason why it can't until the story changes. It's a very narrative-driven market, so there's not much else to say about Nvidia. If people want to talk more about it when we get through everything, we certainly can. I'm just going to jump to the next topic. I'm going to try to knock the rest of these out so that we can maybe in 10, 15 minutes here just open up the discussion. So UAW, again, we've talked extensively about the situation there. There were incremental actions taken today. So we got more strikes at GM and at Stellantis. The UAW opted not to take additional action against Ford Motor at this point in time. So we're talking about walkouts at 38 parts distribution centers across 20 states. Remember, it's been a very different approach that UAW has taken for this action relative to actions it's taken historically, going against all three of them at once, but starting very small and really incrementally ramping this up. This now being at the parts distribution centers, the angle is, well, are their dealerships going to begin to apply pressure? The franchised dealers, are going to eventually run out of parts, which leads to a bad experience for their customers and for the owners of the vehicles. You can talk about longer term economic knock-on effects from more of the auto park running out of replacement parts to keep the vehicles on the road. But we'll see. I don't see any reason why this is going to get resolved near term. It's a really complicated problem without any easy solution. We talked extensively about it on Wednesday night during our open mic. So, as of today, again, the update is that the union is now escalated to kind of impact the distribution centers for these parts for GM and Stellantis. And yeah, we'll see what comes next. But still doesn't seem like it still seems like there's a pretty wide chasm between UAW's extraordinary demands and what the OEs are going to be able to offer them that will satisfy their demands. And the Wall Street Journal reporting notes that there was a purported leak of private messages between UAW's communications director showing him crowing about the union strategy and ability to create chaos. Look, depending on who the source is, you're obviously going to get the OEs unhappy about UAW's actions and vice versa. So, nobody wins in this. It just remains to be seen how long it lasts and how big the damage ends up becoming. So, that's UAW.
Yeah, I'll add on that before we switch over to the CHWY topic. But looking at the president of the UAW's Twitter account, I have one of his tweets pinned in the nest, and it just seems awfully out of line. He's sending out this tweet, the little I can't remember what movie this is. Samuel Jackson saying "TikTok, motherfucker." It just comes off as he's maybe extending his hand a bit much, and I don't know. It's a little tasteless. Some of his tweets, he definitely has a bit. He thinks he has, a hell of a lot of power over the manufacturers, of which he does. But it can't imagine helps the negotiations when he's tweeting things like that.
Yeah. Okay, but we can circle back to UAW if people want to talk about that, talk about labor. Again, it's a topic we've touched on a lot in this broadcast, so we can definitely talk more about it. Joe, you added this section about CHWY, which I've seen a lot of folks talking about it. I had made a comment about it earlier this week. I saw Vince Martin at Overlooked Alpha put out a write-up. I think that they do good due diligence, and I'm personally a subscriber to their paid Substack. So, just kind of, I think Joe in the write-up lifted some of the highlights from that. I won't regurgitate that all now. But look, I mean, that stock in particular has gotten really beaten down over the last couple of months. Looking at the 1 month ago, I think the stock's down. Well, if my computer wants to load. Yeah, over 1 month, it's down 30%. Over 6 months, it's down a hair shy of 50. And if we're talking from mid-July, 2 months ago, it's down about 50%. So, what does that mean? Is the intrinsic value of the business 50% lower than it was? No, I mean this is how markets work. Markets can overextend in both directions. Most of the last few years was overextended to the high end, and perhaps some of these stocks are getting overextended to the low end. When you look at CHWY, I can get my CHWY to load. I had shared a graphic earlier this week just kind of showing how much the enterprise value to gross profit had derated since really since any time during the company's public history. It came public, I believe it was in 2019. So this has been a very richly valued company for all of its time in public markets is one important point to start off with. Looking at IPO, EV to gross profit was almost at 20 times. That's derated down to 2.4 times today, which means that even in July, it was roughly twice that, around 5 times EV to gross profit. Now, obviously, gross profit is not telling us about their overhead costs for warehouses, for selling, for other admin. But this is at least showing us a view of, okay, at the highest level on the income statement, this is a company whose gross profit margins have sequentially been improving almost throughout their time as a public company. So the gross profit margin has risen. The last 12-month margin is up to 28%. It was only 22% when they came public. So, high-level profitability, again, that's not obviously net or even operating profit, but that level of profitability continues to improve. The question mark seems to be this notion, because it's not just CHWY that's fallen a lot in the last couple months. I mean, it's really almost all, a lot of stocks have fallen. But in this space, the pet space, uncertainty around how durable will the consumer spend be. A lot of people got pets in COVID, while historically people have been slow to give up paying for Fido's food and maybe giving Fido over to an animal shelter. It seems that some have the view that that rate will increase in this economic cycle. And I don't have a strong view either way on that. But look, this is the problem with very richly valued businesses, that if your rate of growth is maybe slows, if the outlook changes, if the view is now that this company is perhaps closer to maturity than it was viewed to have been just a year or two ago, then your terminal market penetration is lower, your terminal profit level perhaps is lower. And while I don't again have deep insights or thoughts on CHWY, to me this is a good one to look at, because look, everyone who's bought the stock is now underwater. We're at September 22nd, so over the next roughly 100 days, you'll have a lot of opportunities for people to realize a tax loss, which, as we saw last year, sent a lot of stocks down quite far. And then at the beginning of this year, many of them bounced right back. So there is the wash sale rules that anyone considering taking that action needs to be aware of, so they don't impact themselves that way. But Joe, what we were talking about is trying to put together potentially a list of maybe holiday bargains, companies who maybe the business hasn't structurally been impaired, but the market is pricing it as such, and then it's got that snowball effect of tax loss selling. So I've never owned CHWY. Uh, I'm I'm potentially interested. I have been a consumer. Well, not me, but someone in my household buys things from them. And even though we don't have pets, we have family members with pets, and people like to think about their furry friends as family to some extent. So I don't see that there's been a deterioration in the customer side of things. It still seems like they are at the forefront of kind of delivering a high-end customer experience. But the market again, just huge deterioration in the EV to gross profit multiple. Even though to me it doesn't look like the business is really in bad spots. But look, it's still a very narrowly profitable business on a net basis. The forward price to earnings is actually richer than Nvidia's. Again, according to the sell side analysts, it's 30 times forward, whereas Nvidia's is a couple of turns below that. So, crazy things happen in markets all the time. Is this an opportunity? It certainly could be. And if your view is that long term they have a longer growth runway than the market's attributing, it could be a great entry point. But it definitely shows the risk of paying a rich valuation. And it's still an $8 billion market cap business. At its peak in 21, it got almost to 50 billion. So clearly got a little ahead of itself, but it did IPO at around 14. So it's almost half of its IPO market cap. And this company does not have debt. So they do have, I think, some levers to pull. They've invested in automated fulfillment centers. It's obviously an e-commerce business. So they've got kind of the benefit of not, as far as I know, having to invest incrementally in more of those fulfillment centers. And we'll see what happens to CHWY, but that's one definitely to have, I think, on your maybe holiday bargain list. Perhaps it sells off further into the holiday season. But yeah, Joe, what do you think about CHWY?
I like it. I mean, we talked in the newsletter about how it's um, bringing in record numbers, but it's trading at all time lows, and it's pretty phenomenal what's happened to tech companies over the last year. Really not worth what it used to be, but all other signs tell you it should be worth more than it even IPO'd at, considering the company's only grown since then. So I like it. It's definitely on my radar. We've been talking about doing some stock pitches, and I hope we can even do some more public kind of features like that on our broadcasts. But CHWY is definitely on my radar.
Yeah, we'll see what happens. All right, so I've got two more things to get through here. Um, so there was a story in the Wall Street Journal earlier this week about it had some survey data from the percent of young Americans who are living with their parents. And if I can get my notepad pulled up here. Yeah, there was a graphic that had the survey results. Hang on, let me just pull it over. So, it had a Harris Bloomberg poll of 18 to 29-year-olds who live with their parents, and why are they living with their parents. So for one, we're at the same rate of those aged young adults living with their family as in World War II era in the 1940s. So it's gotten really low. And look, the chart I have below it is how mortgage affordability. This chart is only going back to the late 80s. So even though the headline says mortgage affordability is at an all-time low, it's not an all-time low, although it is a generational low. Early 80s was less affordable. But that's it, right? It's very difficult for young adults to accumulate the necessary financial resources to purchase a home. And now with that affordability at generational lows, we're seeing some byproducts of that. More people living at home, and I don't know what the answer is to that. I mean, clearly the survey respondents say 90% of those surveyed say people shouldn't be judged for moving back home. Um, I know that I'm the oldest of three, and I have one of my siblings still fits into that bucket, although he fortunately did buy a home a couple of years ago. But like I know my sister had moved home, after school. My brother had briefly. And look, the thing you bolded is that it's seen as a pragmatic way to get ahead. The primary response was saving money. I mean, if you can go live with your family, parents, grandparents, somebody in your extended family, it's going to cost you a lot less than rent otherwise would. The professor of social psychology quoted in the story says, "We're living in an economy where it's harder to live independently. Adults recognize that it's tough these days." So just more of an observation of the effects of this high cost of living for a lot of young folks. Yeah. Lastly, briefly, although we can talk more about it when I get done with this here, the Fed, obviously, they opted on Wednesday not to raise interest rates. That was expected pretty broadly. The big changes in the summary of economic projections were this this notion that the Fed may see the longer run neutral rate slightly higher. The long run estimates for Fed funds on the high end of the Fed governor's range rose by 50 basis points, I think from 2.8 to 3.3. Now, granted, the median is still 2.5, but I expect that number is probably going to keep ticking up slightly if we keep seeing this. And obviously that's long run. So talking about 24 and 25 also ticked up. I had a graphic. Here we go. I had a graphic here. This one from Liz Hoffman at Semaphore, which I thought was just a clean way to kind of see. This is how meaningfully Fed member expectations for the rates at the end of 23, 24, and 25 have shifted from March, when they put out the SEP, Summary of Economic Projections, to June to September. So 2025 back in March was expected to be around 3.25, which would be getting pretty close to that long run level. Now we're seeing, as of the SEPs out earlier this week, closer to 4% for 2025. So there's been plenty written about it in the last few days. You all probably heard me many times note I like John Author's points of return column. His column last night kind of made the comparison between climbing the Matterhorn versus more like a tabletop shaped mountain. So the view there being that Fed expects to keep rates higher for longer at this plateau. They may have reached their terminal level. You saw the members, a slight majority, saying there would be another 25 bip hike by year end in the two coming meetings. We'll see. I mean, I'm still of the view that you do have ample slowing of what they want to see in terms of labor market loosening, some of the pricing pressures that are dissipating. We talked about how oil is kind of outside of their purview, which is obviously going to make it more difficult for that core PCE to get to the longer term target. But credit tightness, right? Here's another graphic from Federal Reserve Bank of New York. This is just summarizing all of the survey data on household credit. And you can see, look, we're at the highest level of respondents saying somewhat or much harder. More than half of respondents are saying that it's somewhat or much harder to obtain credit than a year ago. So we're clearly in this continuing credit tightening cycle. And while there may not be much more on the Fed funds side, when we were earlier in the year, everyone was expecting the Fed to be cutting possibly as soon as the end of 23. And now, um, you know, the amount of cuts expected in 2024 continues to dwindle as well. So if there's anything we should know, though, from what the Fed's had to say over the last few years, and I thought was especially true in Powell's Powell's presser on Wednesday, is that they really, I think, are admitting more than they have in the past. They really don't know what's to come. And while these projections are what they see currently, as we know, things can change on a dime. So, yeah, I mean, for now, though, expecting higher for longer, market pricing in more of higher for longer. On the rates side, rates obviously moved up most of this week. And here's a year-to-date graphic of the 2, 5, and 10-year. Look, the 2-year is north of 5.1. I guess it came down just a little bit today, but that's coming on the back of some really significant rising in the longer duration part of the curve over the last few months. So, yeah, all else equal, higher long-term discount rates and higher costs of borrowing should reduce the attractiveness of equity and should reduce equity valuations. For now, and this is not something new, but we've talked a lot about this massive spread between small cap companies and mega caps, and there's some validity to the reality that a lot of these large and mega cap companies have locked in very low cost fixed rate debt for many years, whereas their smaller counterparts have much higher cost of debt and have much higher mix of variable. That's again going to lead to a lot of distress and bankruptcy throughout this cycle. So I don't think we're at the worst of it. There's still a lot of pain to come for equity, for companies having to restructure. But I will say, and I saw someone kind of make the point that there are a lot of opportunities to find companies with hefty free cash flow yields that, just because they're not a popular name, or they're not the flavor of the week, they're getting sold off somewhat indiscriminately. And for now, I think it's a lot of people. This is not me saying anything new, but people, a lot of fund managers keep piling into the mega caps. They know they won't lose their job for buying Apple or insert name here. So the spread is extraordinary between the mega caps and the small caps. There's some justifications for it, but in my view, it's just very overblown. And it doesn't mean small caps don't go lower, but again, if your view is multiple year investment duration, then I think there's some attractive opportunities out there. So, okay, last thing before we just open it up. It's 4:30, so 30 minutes in, we'll open it up to talk about whatever folks want to talk about. But we are moving the book club. So it was supposed to be this coming Tuesday. We're going to move it back 1 week because we have someone on the team on vacation. So I'd like to have as good of a discussion as possible. So The Warren Buffett Way by Robert Hagstrom, our September book club, which we usually hold on the last Tuesday of the month, we're going to hold it a week after. So the first Tuesday of October, we'll have that discussion, 2-hour discussion in the GMEDD Stages channel, where we can talk about the latest book in our book club series. And we're probably going to have to slot in a new book for the end of the year, because we had penciled in Nathaniel Popper's The Degenerate Generation, but he has not yet published the book. So stay tuned. We'll have that finalized by the time we meet not next Tuesday, but the one after. Okay, that's all for prepared discussion. Got Tendy Baron, got D-Bone up here. Jiro, see you in the audience. I know it's late where you're at, but I will happily invite you up if anyone wants to come up. And yeah, feel free we can talk about any of the topics that we went through on the newsletter, or if people want to talk about anything else, wherever we want to go.
Hey, Rod. Hey, Joe.
How's it going?
Good evening. Thank you. I'm doing well. How are you?
Better than ever.
Fantastic. So I was just tuning in. I wanted to join this conversation because you guys were discussing Chewy earlier. I chimed in about halfway, and from what I've heard is you guys are feeling bullish on Chewy, or at least see like opportunity for a long position. Um, I have some different thoughts I would like to share with you, and I mean, of course, like I'm just throwing ideas out here, so let me know what you think. Um, on Chewy, I looked at it last weekend, and it was, I think, at like just above $20 at the time. Um, I wasn't feeling that optimistic on Chewy yet. From what I've seen, is they are planning to grow their operations into
Yep.
Canada, and for this reason, they have pretty substantially increased their SG&A expenses, about 100 mil uh, per quarter, up from like 500 something. So it's about a 20% increase. Um, and like just the current environment we're in, where consumers are like kind of getting squeezed in their wallets and they just have less to spend. Like I think like I'm still looking into it, but my assumption is that most of Chewy's margins come from the services apart from the pet food. So if I look at the revenue streams in Chewy, like by far the majority of the revenue streams is based on the consumables, which is just pet food. I think that's an item that has low margins. That's my assumption. Maybe you have some ideas on that, or maybe I'm completely wrong on this. But I think pet food is like a low margin um, product, and especially it's pretty easy to compete on. I think so. There, I suppose there are existing players in Canada, of course. Um, like anyone can open a store and sell pet food. Like I don't think it's that hard to enter. Um, but it's not only negative. So like what I do like about Chewy is like their pet food service. It's low churn. So it's like once a customer signs up, they are more likely to just stick with Chewy for a longer duration. So I mean, I can definitely see the appeal to that because it would increase like customer lifetime value and stuff. I think so. If my assumption is correct that pet food is like a low margin item, then the real growth in revenue and in earnings, of course, in the bottom line, it would have to come from the other items apart from pet food. So, like, I don't know exactly what other services they all add, but like, I would assume like toys or like like other useful items that you have to have for pets. I think consumers are more likely to downgrade on these items, considering the high inflation environment we're in. Um, so, like to summarize, I think Chewy is increasing their quarterly costs substantially, and they're chasing low margin revenue. And we don't know how long this inflation environment, like this high rate environment, is going to stay. So it might take a long time before Chewy actually sees the results of their operation on the bottom line. And I think the market is not so optimistic about their expansion into Canada. I've heard several times like there's also the Canada curse. Like I'm European, so I don't know exactly what that would like entail, but I would assume it's maybe harder to get into Canada as a business, like for their geographic. I don't know exactly. Maybe you can chime in on that, but yeah, basically that's my thought. So I think it does have a bit lower to go I don't really have like a price target in mind or something, but like I think long term it's a good business to buy, but I think there will be better opportunities to come. So that's my opinion.
I appreciate it, Tendy, and thanks for joining. Yeah, look, the business selling consumables is pretty low margin. I mean, the all-in company margins for the last quarter, if you want to accept adjusted EBITDA, that's 3.1%. If you want to look at net, we're talking less than 1% net margin year to date for the business. So it is a very slim margin business that, if you believe that they've been investing in growth through the income statement, I mentioned the automated fulfillment centers. I don't have a deep insight into their operations, so please don't take this as gospel. My thinking would be that the marginal fulfillment cost for them to tap into the Canadian market with their existing investments wouldn't be that substantial, but I could be wrong. Um, and I agree with you that I do think it goes lower. I think there are plenty of stocks that are going to experience a lot of selling. Now, look, people listening, I'm sure, some want to dunk on our PLBYDD in our Playboy call. I know an investor that owned more than 0.5% of the company that capitulated today, and that sent the stock down several percent. Watching that hit the tape, so tax loss selling is a real overhang, um, and I definitely think that it does make new lows before the bottom is in. But the wonderful thing about it is you don't have to go all in at once if you wanted to dip your toes in. But again, we're not recommending CHWY. We just wanted to talk about CHWY. Chris, you have your hand up. Do you want to chime in?
Yeah, I remember looking at Chewy maybe like a year or so ago, and I think there was like a lawsuit or something they were dealing with regarding pet medications. They want to get into the pet medication market, and that's a big, recurring revenue stream. And given how small these pills are and stuff, like a lot smaller weight than pet food. So I know Amazon has gotten into the pharmaceutical, not pharmaceutical, but like kind of pharmacy business. Um, and yeah, I think that's something that Chewy they seem to be pushing right now. I don't know how successful they'll be, but I remember just Tendy was just asking what kind of other stuff is Chewy getting into. So I just wanted to bring that up.
No, thanks for sharing. Yeah, I'm looking at the last transcript, Tendy, and to your point about the increase in SG&A, quote, this temporary increase was largely driven by corporate payroll increases related to our growth initiatives, such as sponsored ads and our expansion into Canada, ahead of realizing the associated expected net sales growth. So, if you believe them, right, it's them spending before they take in that revenue that they expect, and hopefully margin they expect from the Canadian side. But it's certainly a risk.
Are you saying that? Are you saying that the 100 million SG&A expenses might not be like recurring?
That's what the company is saying.
Okay. Well, I mean, if that's not the case, then my bear idea is not so strong. But okay, good to know. We'll keep an eye on it.
Yeah, for sure.
Yeah, a few of my follows have been trying to get into the pet space, but a lot of the clinics, like veterinarians and such, are private. I think the only exception is I think Nestle, or I forgot the company that one public company that has a stake, a really large company that has a stake in like veterinarians, which is a very profitable business.
Yeah,
but
yeah, Chris. But
I don't know if Chewy's going to go
so
there.
Chris, exactly. I'll read from the latest transcript. They said, longer term, they're excited because they think there's still meaningful gross margin expansion opportunity, specifically in high margin verticals like Chewy Health, and they also see sponsored ads as margin accretive. So I think you're right that they're going to grow there. That's longer run, and obviously there's plenty of people already trying to get into that space. But if you're again, I think that the way they've oriented their business as being very make customers love the experience of interfacing with them, with their Fido and whomever. I think that that's smart, and I just haven't seen a deterioration in that as someone who's a little bit more of a distant observer. So, look, you have noise, you have lumpiness, especially when you're in a geographical expansion where you need to make upfront investment. So, I can tell you, right, what sell side analysts think, but that doesn't mean much of anything. They can be asked backwards. But if you believe their views, then EBITDA is going to grow very meaningfully in the coming few years. So the midpoint of sell side for 24 is a 13% EBITDA growth that ramps to 26% in 25, and then accelerates again. This is, we're talking about a lot of analysts, not just one or two, but for full year 26, there are 11 analysts, and they think the year over year growth from 25 into 26 on the EBITDA line is 30%. So that's some pretty hefty growth, but right, there's of course many risks that it doesn't come to fruition. Perhaps in a weakening consumer, they this go around opt to give their pets up more easily than in the past. I don't know the answers to that, but yeah, we'll see what happens.
Yeah, I'll definitely keep it on my watch list. So we'll see how it goes.
Yeah, I mean, it's nice leverage because the sales estimates are right around 10% for 24, 25, and 26. So clearly, the sell side sees a lot of operating leverage flowing into the model, with them getting sales growth at 10%, but EBITDA growth close to 30%. So yeah, it'd be fun to watch play out.
Yeah, I don't have any concerns on their top line. I do believe they'll manage to grow revenue over time like they have in the past years. And I mean, if you just look at the past few years, it's incredible the revenue growth that they made. So my concern is like maybe where we might be looking at like a Netflix type of situation where a company has to grow at all costs, like chasing the revenue, or like in case of Netflix, chasing subscribers, to only when the growth slows, the stock is gonna drop like a rock, right? So like maybe that's why they're chasing revenue. But like, yeah, if they like, my assumption is pet food is lower margin if they're only managing to grow mostly on the pet food side.
Yeah.
We would see gross margins fall.
Sure,
Like
yeah. If a
over.
mix of consumables rose, I would agree with that. And one other call out I would note is in the latest quarter, their active customer count did decline on a year over year basis by a little less than 1%.
Yeah.
So even though they're wringing more sales out of those active customers, the market clearly thinks growth will be slower than it has been, and perhaps they won't get those operating efficiencies that some folks are penciling in. Yeah.
What's their definition of an active customer, though? Is
We
it like
define active customers as
customers?
the total number of customers who have ordered a product or service, and for whom a product has shipped, or for whom a service has been provided at least once in the preceding 364 days. So at least one
Okay.
transaction in the prior year.
That's interesting. So the revenue growth might have come from a repricing in their products and services rather than like getting more customers.
Well, they're getting
That's what it
almost
looks like. That's what it
15%
sounds like to me.
more net sales per active customer. So even though active customers were slightly down, that's where they're getting deeper penetration and spend, and obviously that's a nominal number.
Yeah, or more products.
Right.
Like maybe
Yeah.
they've upsold more.
Yeah, and I mean, they call out, and I do think there's something to say that 3/4 of their sales come from customers that use their auto ship feature, which, I mean, is it really that difficult to turn off. It's not, but there is the reality that by nature, we're less apt to change things up once we've kind of settled on something. So they do get 75.5% of sales from auto ship customers, which is increasing. So they're getting more from their core customers, but I think, are there more core customers out there they can bring in is perhaps the big question mark.
I'm pretty sure CHWY is losing money on me. I use the $20 coupon every time they send it, and I order heavy stuff.
I would expect nothing less from you, Chris.
There you go. That's why the stock went down. Not just kidding.
All right. Well,
so like, what about CHWY's market share in the USA? Like, do they still have like a lot of room to grow, or are they kind of tapped out again against other like competitors? Do you have any like idea on that, or?
I don't have any like deep insight on like their market share in the US. It seems to be pretty popular, and they can, in theory, right, sell to anybody in the country, right? Because they have fulfillment centers in most regions, while like a pet store, right, like they have all these costs with running a store. And I think where I am, there's this one regional store called Pet Food Express. I don't know if any of you heard of that. And I really love that store. I have 2 cats, and that store is really great. It doesn't stink, right? They don't like sell pets there. They only sell like pet supplies and food, so it's very clean. And it's like in the Bay Area in Southern California area, in LA area, and they have several stores, and they sell some brands that like CHWY doesn't sell all the brands. So I think in the there are different niches in the industry, but like generally, right? Like I would rather order from a CHWY than like go to like a Petco, for example, where it kind of stinks in there, and you don't really know what you're buying when you go in the store.
They did say they're going to host an investor day some point before the end of the year, so I'm sure they'll disclose more information. I'm looking through the transcript, just looking for market share.
November.
I don't see too much discussion, at least from them, in the latest quarter. I didn't see anything in the latest letter, but in the preceding quarter, they had said, quote, as we assessed which geography would be more suitable for our expansion plans, we honed in on Canada's large and growing market, where we see a path to achieving market share and profitability akin to our US business. Now, offhand, I do not know what that level of share is, though.
Okay. Well, something to do more research for.
Yeah, I mean, I think
I'm gonna look into it more
in September to start putting some of these companies like CHWY on that, do some more research list, knowing that there's probably more selling pressure to come. And I mean, look, it may not pass muster. Maybe it's not a good investment. Where I'm just pointing it out as an example of something that's kind of fallen from grace, even though the underlying business itself has improved, right? Sequentially, margins continue to rise, sales rise. You're expecting a lot of growth, but the question I think is, were previous investors simply overpaying for that growth in a low rate environment? And Joe, I know when you spoke with Ryan, who obviously was a co-founder of the company and participated in the sale of the business in 17 or whatever year it was, that he had, I thought, made a comment about, it wouldn't have been the same if they'd done it, in this interest rate environment. I know I'm butchering what he said, but do you remember that, Joe?
Yeah, I think he pretty much just stated that CHWY was really only able to become the size that it was able to grow to under his leadership because of interest rates being as low as they were.
Yep.
I can't remember the exact terminology, but yeah, you're spot on.
So look, the reality is that when your cost of capital goes up, and your discount rates go up, you're less valuable than you were, and it's harder for you to grow. I do see a line here from the company earlier this year about the Canadian market size. So Tendi, like as a rule, Canadian market is generally anywhere from like a tenth to an eighth the size of the U.S., maybe 10, to 12 or so percent of the U.S. So they are seeing Canada's market growing to 12 to 15 billion over the next 4 to 5 years, growing at a slight premium to the US. So I guess if you back out there's probably a high single digit growth rate that they're talking about there. Then we're probably talking about a US pet market that's north of 100, 110 billion. And, what does that imply then? They are, what was their sales? That they're still a single digit percent of the total market. So
Yeah, they would have like 9% then
yeah,
with those numbers.
yep. Again, I'm just going. I don't know this business intimately. Please don't take this as gospel. We're just trying to have a discussion about it. But at a high level, I think that's directionally right.
All right. Well, thank you very much for sharing your thoughts and having me on the platform. So
Yeah,
I'll give the mic to someone else. Thanks so much for having
Thanks,
me.
Yeah, always nice having you, Tendi. Thanks for coming up.
I saw Jiro up here. D-Bone, how are you guys doing?
Thanks, all good, Rod. How are you?
Doing pretty good.
Perfect. Yeah, I was only thinking this time because I read a fairly recent report about credit ratings and about companies. And what's interesting, I mean, this report was actually about European companies, but there are more upgrades than there are downgrades currently, and this is fascinating to me because Europe doesn't have a nowcasting growth model where it looks like that they're growing 5%, right? So Germany is officially in recession. Like if you how do you say? So even the German National Bank or the German Treasury is actually saying that they expect another negative growth, which would be three negative quarters within a year. So that's officially a recession. France also looking terrible. UK, of course, super terrible. So to me, it will be very interesting to see if the rating agencies, because they looked terrible last time, right, with the GFC, and where they were blamed that they gave very, very favorable ratings to all these CDO structures, right? But I think they might embarrass themselves again, if they don't step up and are not willing to downgrade companies, because it's impossible that the economy is shrinking, but the companies overall are doing better. I mean, how is that even possible, right? So that doesn't make any, what I said, doesn't make any logical sense. And yeah, so that's just my 2 cents. I mean, it's just about Europe, but I have to say, like the US, although GDP growth rate is still looking fairly okay, but that's basically just a base effect of inflation, right? Because inflation is coming down quite strongly. I mean, compared to last year of June, where inflation was 9.1%, and now with the GDP deflator, it will be somewhere around 3%. So automatically you will have a higher real growth rate, although nominal growth will come down, right? Okay, so I understand that nominal growth rate coming down is not a big deal, right? Because the only question is, will it come down below long-term growth, or will it come down but stay above or stay at long-term growth rate, right? So, and that's the problem that we have currently, that soft lenders, no lenders, hard lenders all look at the data and it all looks in their favor, right? It's coming down a little bit, right? So the soft lenders can also say, yeah, it's coming exactly down as we want it to be. And the no lenders exactly the same way. But my biggest criticism is actually about the credit rating agencies. Let me actually share this. So if
So you're saying there are more credit upgrades than downgrades on that
In
from the
Yeah,
agencies
in Europe right now from S&P, according
in
to
Europe?
the
Okay.
Commerzbank, how do you say? According to the
You
Commerzbank
you
rating.
know I plead ignorance mostly to Europe, so I don't have anything that insightful to say on the European side. I would add, and I know you, I think, prefer the S&P Global PMI to the ISM. I think in our past
No, I
conversations,
don't. I don't
you'd made
prefer it. I
that.
don't prefer it. I
Okay.
just made the case that they have the same
I don't
methodology.
mean to
Yeah.
put words in
Yeah,
your
yeah,
mouth.
yeah,
I
yeah. No,
simply
no,
was going to note that the flash US composite
Yep,
PMI was out this morning,
yep, yep.
and it showed, I mean, the headline is further loss of service sector momentum weighs on overall US economic performance. And even though the the manufacturing side of the economy may no longer be deteriorating, which I think is consistent from what they're seeing. Their manufacturing index, flash manufacturing output index, was just shy of 50. The manufacturing PMI was just shy of 49. Which again, if it's less than 50, it is still contracting, but at a slower rate than it was previously. That's kind of in line with what the ISM head Tim Fiore has noted about U.S. manufacturing in general. But I think this is the part that, like, okay, great. If it's good if manufacturing has maybe troughed, but let's not forget that manufacturing is, I don't want to call it an inconsequential part of the economy, but relative to services, it's just simply so much smaller that if we see services break down, it doesn't matter if if manufacturing is recovering and that manufacturing has all these maybe fiscal tailwinds
Mm.
from a lot of these policy decisions in the U.S. because services is going to be what drives the aggregate GDP number.
Yeah, yeah. That's actually 100% correct, Rod. The problem is also that in all these recession models that economists use, they they like the manufacturing ISM series because it starts already, I think, almost at 1960 or something, right? Whereas ISM services only
Yep.
started 1997, right? So already you can only train the services components only on the recession of the tech recession and the global financial crisis. Oh, okay. You could also train it on COVID, of course, but there is not a lot of recession that you can train it on, right? But I agree with your point that in the 1960s, manufacturing was a very big part of the economy and of growth, right? Whereas now it has completely switched, right? I mean, now it's 70% probably of the economy, and back then services was maybe 30%, right? So. Um, yeah, I mean, services is definitely the thing that we have to look at more. But I also want to be open, right? Because I don't want to be one of these people, because I believe in a hard landing, right? But I don't want to be one of these people who who cannot who cannot change his idea or his view, right? So
No, of
so
course.
I have to think about, okay, so what would change my mind, right? And I would say I would change my mind if Bec- because in the end depends, right? Because the US is still looking fairly good, even if Atlanta GDP now doesn't come in at 5%. Let's say it comes in at 3.5%. Okay, it's still amazing, right? It's double the growth of long-term trend, right? So I would change my mind if actually what is happening would be that how do you say it? That Europe would recover, and how do you say it? The US is kind of the leader in the cycle, and Europe and China would follow them. If I saw this, a recovery in Europe and China, then I would say, okay, there's no recession. Uh, whereas at the moment, I believe that Europe and China is leading, and that the US is lagging in that case, right? No, no. So, but in the end, I don't know, right? But I want to be open to this idea as well that it's totally possible that, okay, it looked like a recession for a very long time. Um, yeah, but that's what I would need to see. Also recovering services, ISM, as you said, and most importantly, probably, or even more importantly, would be how do you say, the senior loan officer survey. If they stop tightening, or if companies didn't complain about tightening conditions, uh, then that would be, of course, also very positive for how do you say, for riskier assets. And if I had to pick and choose like a company that would confirm, how do you say, like macro views, it would be actually Apple, because everybody is worried about price increases, inflation, wage price spiral, right? So Apple increased the prices again, and we'll see next quarter or next quarter, right? If the revenues are coming down, or if they can keep up the revenues, right? Because I think if a company like Apple cannot raise prices without deteriorating sales, that would be a problem, of course, right? Because if Apple cannot do it, then how do you say? Then all the other average companies can also not do it, right? So that would be a very good leading indicator, actually, like the next quarterly earnings report of Apple.
Right. And I know from what I've seen reported in the media, the demand for the highest end model, which they did raise the
Yep,
price by $100, which is what, like 7-8% price hike versus the preceding model,
yep.
that it is in very high demand worldwide, it seems. So yeah, I mean, we'll have to see when they report. But I mean, they're just, it's hard with that one too, because it's hard to disconnect the stock from the business. But you're right. If companies can keep taking price, well, that'll be a good sign for demand.
Yeah, I mean the UAW thing, because I'm sorry, I think I missed that part when you presented it. Um, because so many people are complaining about that they are asking too much. I think initially it was 40%, then it was 36%, and
They were asking for not just the
yeah,
40%, they were asking for a reinstatement of the
defined
pensions. They were
benefit. Yeah,
asking
yeah.
for a 32-hour work week. These were some extraordinary requests, I think.
Yeah,
But yeah, go ahead.
yeah, but I think it's very smart negotiation tactic, right? I mean, they know exactly that they will not get all of it, but I have to say, like, if I had a manager like this negotiator is a good guy. I would like to have him on my side if I negotiated my next salary. but um, no, it will be interesting to see. Like, let's say they get in the upper 20s. Let's say they get something like 27%. Yeah. I mean, this might be a leading signal, right? Because all the other employees who are also not part of unions, right, when they see that, or
If they got
yeah,
27%, then the UAW workers would be nearly twice that pay scale of Tesla workers,
I
which
see.
is,
Okay.
again, just showing you how structurally
Yeah,
screwed,
yeah.
kind of, it's a lose-lose, I think, here.
Okay. Well,
Like UAW's requests, you mentioned, okay, maybe it is a good negotiating tactic. I think it's actually a very short-sighted approach. They have a lot of grievances from the preceding negotiating rounds, go back 15 years. But I just think they're ignorant of reality if they think that their employers are going to survive longer term if they force them to meet those demands.
yeah, but I think it's also because they negotiated every 4 years, right? And so, of course, back then they couldn't know that inflation last year would be 9%, right? So, of course, they probably negotiated, I don't know, an inflation rate of 3% maximum, or 2%, right? Because we had in the last since the global financial crisis, we had inflation below 2%, right? So of course they were missing out on a lot. So I think part of their demand is actually a catch up on the missed out inflation adjustment of the past. So I actually understand.
That is true.
Huh?
And I mentioned
Yeah, yeah.
earlier that Ford has agreed to reinstate the cost of living adjustment piece, which
Ah,
UAW opted not to take incremental action against Ford today. So
okay.
that's meeting them somewhere to that point.
I see, I see. Yeah, I'm just saying in the end, like for the global economy, right? What would that mean? Let's say they agree on 27%, because because I think the chief negotiator or because I forgot his name. I don't know.
Fain.
Bain is his name, sorry? Fain,
Fain.
okay.
Fain.
Fain, okay. Um, he will not be
Well, he's the
okay
president.
with
Sorry.
25, I believe, right? I mean, he's a tough negotiator. Okay, let's say 27, or let's say 25, whatever. Uh, I think this could trigger something, right? Because you also had the UPS wage negotiation. You had the what is it called? The pilot wage negotiation as well, right? So these are all events, right? So even if you don't have a union, at the next meeting with your line manager, right, when you negotiate the salary for the next year, I'm pretty sure that you will use it, how do you say, as a tool to leverage, right, and say, okay, they also got this and they got this. So I'm just wondering, like, with if they get 27%, right? So this might keep wages fairly high, right? And this would be a problem for profit margin, as you said, right? Of course, because you said that
Right.
Ford cannot be competitive if the wages are so high. So I think if I had to select stocks, I'm not investing in stocks at all at the moment. But if I had to, then I would invest in stocks where they don't have so much, how to say, like labor costs, right? Like industries that don't employ so much labor. So probably away from services sectors, right, and more towards the more manufacturing heavy companies, because the labor component is much smaller of their expenses, right? If you have a company like Facebook, then actually all of their expenses, or most of the expenses, is actually labor, I believe, right? Um, but if you have a manufacturing company like man, I don't know. I cannot come up with a company right now, but a company that has much more, how do you say, like much less labor costs, right? I think that might be a good hedge, as long as we don't know how these wage negotiations end.
Yeah, and there's the political reality that we're, what, 14 months away from a presidential election here. So UAW is disproportionately represented in swing states. You know, it's a tough situation, because you just have a structurally lower amount of demand needed for the future of automotive manufacturing, and if you make the big three structurally uncompetitive, then you're just going to have bankruptcies. And I get that they're upset about the spread between what executives are being paid and what they are. Um, I just it's a rock and a hard place.
I agree. So which sectors do you prefer at the moment?
Well, I still think energy is broadly undervalued. Um, oil, I think, could trade north of $100, and that won't meaningfully bite demand. I mean, $100 oil today is a lot different than $100 oil 15 years ago, right? The the effect of inflation makes it far less in dollars. So I like energy. I think there's a lot of interesting stuff in healthcare. Uh, I definitely think technology has a very rude awakening coming for it.
Yeah, it's actually a fairly fair point, because I also think that oil price might not have peaked yet, and also this I think it's called what is it called again? This reserve oil facility that that the U.S. government has, right? Which is not
The Strategic Petroleum Reserve.
SPR, exactly. Thank you. Yeah, I mean that will also be very expensive, right? When they have to fill it up again with now way higher oil prices. So, yeah, and the supply cuts, I believe, from Russia and from OPEC will last until end of the year. And now we also have like
Right.
heating season also, right? Starting soon. I mean, we have end of September, so wow, I think there can be a little bit more upside for sure. So and
Hey, look, and
yeah,
Saudi and Russia would be quite happy to see a change in administration, and I think that
uh,
we cannot ignore the geopolitical realities of the global oil markets and the actions they've taken to restrain supply of both crude as well as refined products now from the Russian diesel reductions.
could be, yeah. Very interesting. Um, yeah, yeah. Who knows? And then also, I mean, we haven't seen this spike in gas prices yet. I believe last time I checked, right? So that might be the next one. And then wow, and then at least on a headline basis, we could have again like crazy inflation picking up again because of seasonality. So um, yeah, yeah.
I don't know, Joe. I think you've seen a spike in gas prices. What is it now in Southern
I saw a
California?
photo the other day. It was somebody put it on their Instagram. So they said new high score, and it was like 7 something. So it really is all over the place.
Which, I mean, Americans, we're spoiled because the Europeans have been paying far more than that for a long time.
Yeah, I think last fill up of mine is about $140. I think it was about $6 a gallon.
Okay, fair point. Yeah, it's very interesting. Okay, so you guys are bullish on energy stocks. Okay, no, makes sense in the current environment.
Yeah, I mean,
Yeah.
look, I've been very overweight energy for almost all of the year, and I've been trimming in my personal account somewhat, but it's still almost a quarter of my PA is energy. So,
Wow.
yeah, very overweight relative to the index. I mean, I just see that real assets, like companies printing money, like those companies are still just historically very undervalued,
Yeah.
and they're not sexy, right? No one who maybe has an ESG mandate is going to be able to touch them. I like nicotine for that
Yeah. Yeah.
reason. Well, not just for that reason, but as well. Um, so yeah, a lot of the stuff that no one wants to touch. But
Yeah, I have to say this ESG thing, like, I mean, I don't know if you heard in Germany, right? Like 2 months ago, they got rid of all, how do you say, of all of nuclear energy, right? They shut down everything, and now we are in this ridiculous situation where Germany can say on one hand, okay, we are not producing any nuclear energy anymore because we shut down all the plants, but we are importing it from France. So it is ridiculous, right? Like, and it's so much more expensive. So actually, you are upsetting your own people with how do you say, with higher prices, but you want to look good for all the ESG rating companies, right? That you can say we are not using any nuclear anymore. Although I'm not even sure anymore if nuclear is considered ESG or not ESG, right? It's a tricky gray area, I believe.
right, I mean, it's the cleanest energy source on the planet,
Exactly.
but somehow it's not environmental. I don't understand it.
Yeah, yeah. It's because of the waste,
thankfully,
right?
thankfully, don't have to care about that. We don't have any mandate like that that requires us to buy only solar farms.
Yeah, I mean, don't get me wrong. I believe that we cannot stop this train anymore, or nobody can stop this train anymore, right? We will become a sustainable society, or how do you say, like, we will, like, there will be electric cars everywhere, right? But it will not be now, right? It will be a very slow process, and I think this is something that many people underestimated, right? That if you want to become a climate neutral, how do you say, climate neutral society, that it takes a lot of time. And
It would take a lot of small nuclear reactors to be brought into the fleet. Small modular. I am not a nuclear engineer, but if you wanted to really get to net zero, if those who purport to be green really wanted to be green, then they would need to very aggressively embrace nuclear plant expansion. And unfortunately, I don't know, they've deluded themselves into thinking it's not a clean energy source.
Yeah. Does maybe anybody in the audience know any interesting, sexy company that is working on a new, I don't know, on a new medicational drug or any new trendy, how do you say it, like trendy thematic thing? Because for instance, how do you say, in the global life sciences area, right? There are a couple of interesting things going on. I don't know if you heard in Denmark, they actually prevented a negative GDP quota because of pharma, because they started with a weight loss medication. How do you say? Because I don't know if you heard of it, Rod. Like when you take this pill, right? Then you don't have appetite, or you have much less appetite, right? And
Yes, I mean I've heard, I've listened to some people discuss it. Some people have a view that it's going to impair some of these junk and snack food businesses.
yeah.
I personally don't have any informed view on it.
Yeah, but I think the problem is that it will happen one day, right? But in the beginning, like all these junk food businesses, I mean, they have because they have a very strong lobby, right? They will rebrand themselves, and they will how do you say it? They will put on a fight, right? I think sometimes all these forecasts are always assuming, right, that there is a new thing, which will be a revolution, and then all the other industries just die away. How do you say, without a fight? But it rarely happens, right? Uh, and I think that's why we have to be cautious, right? I mean, I am very bullish on certain things that I see, right? But I'm also aware that there are time lags, and changes happen often very slowly.
Yeah, I saw, you may have seen, Edwin Dorsey's The Bear Cave publication had put out a short viewpoint on Coca-Cola. And I know he had, and I've seen a lot of people kind of talk about what are the implications of the Wegovy, Ozempic on companies like Coca-Cola and Hershey and others. I I don't have a very informed view, so perhaps it's a big deal. I'm inclined to fade the notion that every new thing is the next big thing. But Baron, you came up. Did you want to chime in?
Can you hear me?
Yeah.
Okay. I think you people were talking about GLP drugs. The one from Novo Nordisk, and there is another one from Eli Lilly.
Yeah, correct, Baron.
Yeah. But once you look at their side effects, you would be scared to take them just for weight loss. So I don't know how these drugs got like approved by the regulators. I know nothing about the medical domain, but I just looked at their sheet for the paper they put for the side effects, and you have what is the cancers and whatnot. The side effects are really, I don't know, but maybe they have done something to reduce those side effects. But what worries me, like these stocks have run a lot, like Nvidia, and what worries me, like this company in future, they might have some kind of like tail end risk, like where they get sued by people in USA, and you know how the culture is in Americas. So maybe in Europe they don't risk much, or in Asia, but in USA, even for small things like that, I mean, the attorneys would be behind their back. So we have seen that with, there's a approved, there's a drug from 1970s, uh, to reduce acid production in stomach. I forgot its name, and I think there is two drug companies which are being sued for like $1 billion, because it's not that the drug caused them some side effects, but there was some chemical added to prolong its shelf life that has maybe some statistical relation to increase in certain type of cancers, which hasn't been proven yet. But still, they are paying a lot of money to settle those cases. So I would be cautious.
Yeah. Who knows where the future goes with this? Last one, before you chime in, I was going to say I'd read a transcript. CVS had been asked about what kind of the impact of the GLP-1s are, for them. And this was last week. They'd said it's probably a modest positive because it's not covered on most of their fully insured contracts. So they are getting not, I guess, much of an impact on healthcare benefits, but it's benefiting their PBM business, the pharmacy benefit management business. And they said, quote, "This is like case exhibit A1 in the ability of a PBM to drive down costs for high cost drugs." And you can really see it already on this class of drugs. So, whether these drugs become broadly a component of healthcare insurance, I have no idea, but for the time being, they're not. And that's at least CBS's take on it. The last one you came up, do you want to chime in?
Yeah, I got a quick question. You think if the UAW strike continues, that economists might be, or our investors might be concerned about the economy, and that brings and that drives yields lower going forward?
I don't know that it's that large of a component of the economy that in isolation it would lead the Fed to take any sort of an action. I mean,
No,
it's going
not
to
not.
impact.
I'm not the Fed, just the market participants, right? What kind of drove the yields to unsteepen was and kind of spooked the market out after the Fed meetings, because the Fed was was kind of bullish on the economy, and that indicates that they're going to be higher for longer. But and that's what's kind of and that's why the market was it was steepening the yield. But I mean, unsteepening. Uh, so so now the UW, because I kind of been hearing where a couple economists are writing about it, where they think that it might the sentiment it might put a drag on the sentiment of the economy being robust, and then that might bring yields down, which might be positive for stocks.
Yeah, I mean, we're talking about what less than what 1/10 or roughly 1 or 2 tenths of 1% of all labor force participants that are members of the UAW. I just don't know that it's going to spread beyond the impacts that it'll have on stuff that directly touches it, like negatively impacting T1, 2, 3 suppliers, impacting logistics partners. Again, I worked at Ryder in 2019 during the General Motors strike, and it cost the company money. It costs everybody money who's associated with it. So I just don't think it's the type of thing that's going to have a big macroeconomic impact on the United States economy. Now, look, are you going to have some local economies impacted? Absolutely. some companies are going to bear more idiosyncratic risk than others. I don't think that a long-running strike is going to have a material effect on yield curves or on the rates markets. But again, I could be wrong on that. All right, and look, ape folk, if your intention is to request to speak to sidetrack the discussion, I'm just going to block and remove you, as I've done to Silly Vitor and several others. So, if you want to keep requesting, just FYI, I'm not going to bring you up if it's very clear what your intention is. So it's 5:30. We've talked about a few different topics. We'll wrap this up pretty soon here. So, what else do we have going on? We're coming up on the end of the third quarter. I really do think, if you guys and gals are seeing interesting securities that might be good, worth digging into more come the next few months as tax loss season sends things lower than one could have thought, please feel free to share those, and maybe we can do some mini deep dives or have some discussions on those, sort of like we did with CHWY today. I think there's going to be a lot of interesting opportunities, especially outside of the popular companies everyone on FinTwit talks about. And I would love it if we were able to come up with some interesting investment plays, if you will.
I think the whole I don't know if you follow payment sector, but the whole the payment technology sector that has really sold off. Square, PayPal, Adyen, everything. Everything is in gutters. So, but there's a lot of
that is a space that you're right. Is everyone going to get just butchered because of how much competition there is? PayPal's almost looking like a value stock, at least on its face, with a forward PE that's almost in the single digits. Obviously, Adyen had been very richly valued, and it took a massive haircut in the very near term. People's views have seemed to shift very negatively on payments this year.
I still think among all these stocks, at least at current prices, Adyen remains the best bet. Because even if in terms of price to sales, it's richly valued, but I think it's on completely different level, at least in terms of its management and the way the company is managed. They really have a good grip on their cost structure, and they don't do. For a long-term investor, if they can get around these competitive pressures, I think it should do good. But I don't know. We are hearing a lot of reports PayPal. They have a division called Braintree. They are gaining some market share back from Adyen. So yeah, but Square, do you have any idea why this has sold off so much? Square, I know the management is really bad at Square, and they do a lot of SBC. So there's always constantly the shares are coming for sale, always. No buyback.
Aaron, I don't even know what Square's ticker is. That's how little I know about the business.
It's SQ. We're talking block.
Yeah.
It was a FinTwit darling. This stock was
Yeah, look, I use the Cash App sometimes, but I just know nothing about this business. It's valued at a $27 billion market cap, trading at a 16 times next 12-month EV to EBITDA, which I just don't have any knowledge of the
On
business.
price to sales, it doesn't look like it doesn't look too richly valued, at least relatively speaking, from what it used to trade in 2021. But yes, they are barely profitable. And why they are barely profitable? Because management is there just to enrich themselves. So it is what it is. But I think there may be some lot of opportunities. I don't know if you have heard a name of a company called FIS,
Yes.
Fidelity. Fidelity, yeah. They did a quite costly acquisition, I think, in 2018 of WorldPay. It is one of the world's biggest payment processor, and now they are trying to offload it. And to offload that, I think some of these banks like Bank of America and JPM, they are doing after Twitter. It is one of the biggest syndicated leveraged debt deal, and they're trying to sell it, some part of the company, I think more than 50%, to a private equity player. So this is one of the stocks I have my eye on, because they have two businesses. They have this WorldPay business, and they have their software business where they like provide core banking tools, especially to small and medium-sized banks. So even that sector has not performed, but I think from valuation point, yeah, they are currently like the valuation is good, but I don't know. The stock has been making some bottoming. I mean, there's maybe it looks like a switch in terms of risk reversal. So this is one of the stocks I have in my watch list.
What do you think, Baron, about just the big payment players, Visa and MasterCard? Do you own either of them, or?
I have owned them, but I think those are like low beta stocks. So I mean, I think right now they are correctly valued. I just think they are correctly valued. I don't. I mean, yes, you can own them for like really long term, and so maybe your performance would be something like S&P. But
I
it's
mean, you'll probably get a low, maybe low double-digit total return with those. Which you're right. That means they're probably fairly valued.
yes. So I mean, yes, it could be a part of like core portfolio, but those are not the stocks I'm like currently looking at, because I think all the good news there is priced already. That is the way I see. And I don't know why it doesn't happen in US, but their competitive advantages can flip any day. This is just if you look some of those developing countries like Brazil and India, right now it's the central bank payment rails that lot of payment processors are using. Why it can't happen in United States? Maybe because of lobbying or something like that. Because a payment can go from point A to point B, it doesn't have to go through Visa or MasterCard.
Yeah. Oh,
But I think
you made a good point. Like I know when they rolled out Fed now, I remember I was reading articles about it, and they were saying that that's going to be a threat to the payment system from like PayPal and the Square. And if you look at it, ever since they came out, it kind of correlates with those stocks being down. So I don't know. Does anybody got any insight in that? How it affects
uh,
it?
I think Visa and MasterCard have much better moat than what Squares and PayPal's have. But the thing is,
What's what's Fed now? It's kind of like there's no need for them. It kind of cuts into their business.
exactly. I mean, technically, yes, it is possible like that.
I'm talking about
That
with cash. There's like Cash App basically with Fed when Fed now gets fully implemented in a lot of payment system and a lot of like apps and stuff like integrated. There's no need for like Cash App.
I think the Cash App is just the front end part of the payment trail because the where the MasterCard and Visa they come into play, that is the back end part of the payment trail. Once you get through the payment processor, but I don't know. I don't know because I don't live in US, so I don't know if Cash App is peer to peer or it also uses the Visa or MasterCard rails. Any idea, Rod?
I'm not sure. It's free peer to peer when you do the slowest means of payment. So I imagine it's just using the ACH network.
Yes, I think yeah, you're right. It's peer to peer. So yeah.
One thing I've noticed with all of those, and it's especially cringy with Robinhood, is anytime you try to do an external transfer, that would be a free ACH for the consumer. All of these companies have been trying to get these, nasty little fees for instant transfers, which, it's annoying because for some of them, they almost make it the default. And, I just know a lot of people are paying them unwittingly.
Yes. And also I think there has been some concern on Cash App that maybe like they support some form of like criminal activity and whatnot. I'm not so sure. There was a short seller who published a report on it.
So this is what I found online right now. It said it goes unlike services like PayPal, Venmo, Square apps, which are non-bank closed loop systems. The FedNow service will provide an inter-bank faster payment system. So it is a direct, and this is on the frbservice.org site. So this is so I think the decline in their stock prices is directly tied to FedNow. And then I remember when it first came out, there are people were highlighting that. They said that was going to be a threat to their business model. So I think that's why you're reflecting on their price. If you look, Square went from 80. And Square had a good earnings that just came out too, and their stock shot up to 80, and now it's at $44. And it's all from the Fed now came out in July, and it all happened at around the same time it came out. So I think it's directly correlated to that.
I'm not sure because Square like this Cash App thing maybe it's like C2C or B2C. I think where these companies make money is not like when we talk about PayPal, people think like it's the app to send money, but the PayPal doesn't make a lot of money on the app where you send money or you hold your wallets. It's the payment processing part that is B2B, where they like charge the institutional client some basis point on every transaction whenever you use a credit card in a departmental store or something like that. That is the part of business which is lucrative to them, and that is where they have a lot of competitive pressure from Adyen and among themselves. So they have like FIS, you have Pfizer, you also have like subsidiaries of banks like JPM or Bank of America. There are like at least 10 players in that arena which are called payment processor, and that is the liquidity part for them, and that is where there is a lot of competitive pressure. But let's see. I don't think they make a lot of money on things like Cash App or there is another similar app from PayPal also. I forgot the name.
All right. 15-minute warning. We'll wrap at the top of the hour. So good payments discussion, guys. I'm really interested in if anyone has any views on real estate and maybe the home builders, because it's been such a weird cycle, and we're still seeing it where there's been such a supply shock in housing that even though demand has fallen, supply has fallen further, pushing up price. And whether anyone has a view on what comes next in real estate. I mean, my view is that price must fall. I don't know when. I don't think it's structurally possible for rents to just rise to catch up. We mentioned in the beginning of the call that housing affordability is at multi-decade lows, and you're getting this in the short term, the market doing what the market does, supply coming offline, people unable or unwilling to sell out of their low fixed rate mortgages domestically. Again, the US housing market is a very different beast than a lot of international markets, given the way in which the GSEs enable these low long-term fixed rate mortgages, which we talked about how it's a majority, large majority are locked in at rates below 4% below, even in many cases 3%. And there's been the talk for a while now about how there's a lot of multifamily housing coming online. Again, if we talk about all these people living at home, those people living at home, their likely next step is probably not going to be to buy the starter home if there's no supply and the affordability is out the wazoo. Perhaps it's moving into one of those new build apartments that's springing up somewhere in their neighborhood. So maybe we wrap it on real estate and housing if people want to discuss that.
Frankly, these things related to macro, I find them super complicated because I still think like even expert, they get it wrong. But the part that I don't understand is like, if you raise rates and if the market is in short supply, it would cause prices to increase more, no? Or at least the market to remain tight, because what you need is increase in supply. But if people cannot afford it, or if the inflation is high, how maybe the builders they won't make new houses, or if the buyers cannot finance it because the market rates are like 7.5%, more than 7%, then it would hamper the supply. So I don't know how increasing the rate solves this problem. That's why I can't get my head around the fact that when people say la, the rates can go back to like 10%, like what we had in 80s. Yes, maybe, but it would cause enormous problems to like people in society. Like if already they cannot, and it would put upward pressure on rents. So instead of solving the inflation problem, it would aggravate it. What do you think?
Sick, do you want to chime in on this?
I got part of that convo. Like I kind of like I got Elon a little bit. But the just to recap what he just said right now. Right now because of can you give me a quick synopsis of what you just said right now? I know you were talking about rates and like the falling demand, or like just demand in general. But I did have a couple notes I did wanted to bring up in a second.
No, my point is, if rates keep on moving up, it doesn't solve the housing problem, because the housing problem is we are short in supply everywhere. In most of the developed countries, we are short in supply, and we cannot build new houses. The land scarce, so and the material cost has gone through roof. So it doesn't solve the
Actually,
supply
material
problem.
costs have come down a lot. No, lumber futures are they not back? So
Well,
lumber futures are
not
back at $500. Is what I'm seeing.
yes, but then the labor cost is quite high. So one way or other, we can say the cost is high compared to what we had in 2018 and 2019, but before COVID, and the people cannot finance their houses. So
Yeah.
it puts problems for the new supply to come in.
And another reality of housing is that while most industries see productivity gains over time, from some of the literature I've read, housing construction is one of the few that's actually seen productivity go in the opposite direction. On net, each worker is less productive than they were, several decades ago. So, that while, yeah, like the raw commodity input of lumber is, it's a crazy chart. Let me again share my screen. It's below the levels it got up to in 2018. It's still below where it was in late 2019 by maybe 10%. But yeah, it's a tough predicament. And then you have a lot of localized issues where, say, you're in California and the local government won't allow multifamily housing developments because of NIMBYism, and you just force the continued suburban sprawl, single family homes everywhere because you can't get zoning approved to build, multifamily housing. So yeah, you're right, Baron. I mean, there's a lot of nuance and problems and housing, and it is more of a macro discussion.
And even if you solve those problems, the thing you said, like, even let's say you can increase the supply, the thing is you always have houses where you don't want to buy them because you have the societal things, like you want to buy houses where there are good schools and whatnot. And I mean, you go to any big cities, the good schools, if they are public, they are in scarce supply already. So it's not just about housing. So everyone wants to buy the houses in the same same neighborhoods, and that is what causes also supply problems. Sorry, demand aggravates demand problem. Thanks.
Go ahead, man.
Sure. Yeah, I want to bring up on like the local issues that you were talking about, but like let's say California. There was a lot of effort that got passed through. For instance, like in the Los Angeles area, they are passing a mansion tax right now. So anything if you sell like a house above the $10 million mark, they add an extra tax. So they're trying to kind of kill off real estate as a kind of a investment vehicle. But also, I mean, like, there's also like the localized problems. Also, like you just mentioned a second ago. Like for instance, like Santa Monica had a really bad track record of issuing building permits. Like it took the state of California, like the government of California, to tell the city of Santa Monica, like, hey, you gotta like release more permits. Like they forced the city to release like 16 years worth of permits in literally I think like it was a year ago. But there's also like you said, the localized issues that like I have no idea how they're gonna get around. Like for instance, like the city of Irvine, like you're not really owning the property. Like it's I forgot the term, like land grant or like land trust. Like the land is actually owned by a trust, and you just like lease out the land or for like something similar to like the Chinese were doing, right? If I don't know if Chris is still here, but he could probably talk about that area, like in the Irvine area. And then, but I am seeing noticeable effects. Like for instance, the mansion tax. Some of the houses that were selling for like 30-40 million dollars, they're selling for like 10% less now. Like you see like a literal $10 million cut on some of these houses. And then for the rents, for we peaked last year, last August here in the LA area, but I've been seeing steady decline every single month, like about like 5%. So I'm hoping that we get to hopefully as close to the pre-pandemic levels before I move back out like to the metro area again. So fingers crossed, and hopefully there is a little bit more of a dip in the real estate sector.
Yeah, I mean, 30-year fixed rate mortgage, we're talking about making near quarter century highs in what the average rate is. I have the Fed data on the screen in front of me. So again, it's just a mathematical function. All else equal, as rate goes up, price should go down because of the dynamics we were talking about. Prices haven't gone down, which just keeps pushing affordability worse and worse. So I'm of the opinion that unless you get an uptick in until you get the uptick in unemployment, you start to see initial jobless claims really begin to rise, which we've yet to get any of that. That you won't really get housing supply, coming into the market from foreclosures. Demographically, you do have a lot of old people who own a lot of housing, and we'll see if they ever decide to sell any of it. But I don't know. I'm not going to solve this discussion and problem in the next 5 minutes, but I do want to say thank you, Baron and Sick and everybody, Tendi, for who came up and spoke. Again, I had several people who requested to speak, but when we looked at their profiles, it was very clear their intention was simply to sidetrack the conversation. They were blocked and removed from the discussion. We're go do that elsewhere. go have your own space and throw poop at each other. Joe,
can I say a thing? Like I was listening to you. I was listening to, and I did not completely listen to discussion on a stock, the stock called CHEWY. CHWY. I don't know what they do, but I follow a guy who is like a really good trader. He has like a bizarre style of trading, but he's really good trader. What he does is he follows the options flow. And he makes an Excel. He used to be in Twitter, but he has left Twitter. Now they have a service, and he used to make Excel. So in that Excel, you can follow all the bearish and bullish options flow. So he would note every unusual options flow. And I think he has been noting a lot of bullish options flow on this stock. That's what I wanted to tell you. And sometimes what happens, like on small caps and everything, like so the company has gets bid up for an acquisition today, and just 2 or 3 days before there is big call buying and whatnot. That this happened on Splunk. And I still have his sheet. Like I saw that acquisition of Splunk by Cisco, and 2 or 3 days before he was saying that he's seeing some bullish flow on call buying on Splunk. So I think there are always people who know about things.
Yeah, that's definitely a trading strategy. I know a lot of people have embraced in the last few years, just looking for unusual options flow, and some people just simply following it with no familiarity with the business at all. And if you're a trader, that could work. If it works for you, great. CHWY, we talked about the business a little bit. I mean, it's, if you want to bear and re-listen, it was in the beginning part of the conversation that was recorded, but well, the notion that we had though was this is the type of scenario where the underlying operating business appears to be continuously improving while the market value continues to decline due to multiple compression. And we kind of want to assemble a list of companies like that going into the end of the year where the tax loss indiscriminate selling may lead to outsized opportunities.
So Rod, so I'm just looking at his Excel. So he classes his trades in three types. So for 1 month bullish bearish flows, 2 week and 1 week. So I'm seeing this name getting mentioned in all 3 sheets. So maybe we don't know. He has seen a lot of bullish options flow on this name. Maybe it gets bought out or whatnot. I'll study this business.
Okay.
I never looked at it, so I'll look at it this week.
Well, thank you for sharing that information. And with that, Joe, do you want to give a little roundup of programming and what we're looking to accomplish here before we sign off for the week?
Yeah. So thanks everyone for tuning in. It was the 51st Wook in Review. We host these every Friday at the close on this account, and then over on at GMEDD, we are hosting the open mics. So if you haven't tuned into the open mic yet, it's a bit looser of a discussion. We don't really have any sort of presentation at the beginning. It's just kind of a bit of a free-for-all, and we typically allow just about anyone to come up and speak in those, and it is a good time. So try to tune in last week, or this last open mic from this week was a 3-hour discussion. So that was pretty long one. Had a good time talking stocks this week. So yeah, tune in next week to the open mic. We've pushed the book club back 1 week. We have a team member who is unable to be there for the scheduled date this upcoming Tuesday. So if you'd still like to participate, there's time to read the book. It's time to read some summaries. Anything at all, just come forth and just chit chat with us. That's on next, not this upcoming Tuesday, but the one after over on the GMEDD Discord. You can join that by visiting wook.gg, and that'll take you into our Discord. There's 7,000 or so other members. You can chit chat about stocks. So it's a good discussion. But thanks everyone for tuning in. Rod, if you have anything else you'd like to add, go ahead.
No, that's it. Look, our intention here is to talk about different sectors, different companies, and hopefully crowdsource some research productively together. I know that some people's opinion of due diligence varies from ours, but our hope is to conduct quality due diligence over time, ideally achieving investment alpha through uncovering nuggets of knowledge that other people miss. So look forward to hopefully compiling some interesting companies that, as we head into this tax loss season, maybe fit the bill to take a deeper look at. And well, yeah, as Joe said, we'll be back next week. Hope to talk to all of you then. Cheers, everybody. Have a nice rest of your week and enjoy your weekend.